Let's get to top picks from Gordon Reid. Gordon, your first idea is Chubb, the specialty insurer.
Yes, Sandy, P&C insurer primarily. We're going through a period of strong pricing trends within the insurance industry. Underwriting results have been very strong. Combined ratios have been falling, which is good, meaning that they're covering all of their costs just through their underwriting, and any other income that they get is gravy. And that income comes from a ever attractive area, and that is the investments that they hold in the bond markets. And with higher rates, reinvestment opportunities get that much better. So this is a stock that's trading at 1.3 times book. That's about its historical level. So we like that, but organically it's growing well, and we think that it has legs.
Okay, so you would stick with that one. Clean Harbors is an environmental services company, cleaning company.
Well, yes, they take care of environmental and waste from, well, they own Safety Clean as an example, and Safety Clean collects about 200 million gallons of used product, mostly oil product, that type of thing, and they deal with it mostly through re-refining, Andy, which is interesting. There's a strong market for that. They've got pricing behind them as well. They've been able to pass along price increases to compensate for the inflationary pressures on their input costs. And their operating margins have been expanding over the years, up about 20% over the last 2 to 3 years. So we like that very much.
Okay, and then your final idea, Alphabet, aka Google.
Yeah, it's come down a lot. You know, the FANG stocks have been out of favor, but when you look at what Alphabet, Google is doing, it remains very exciting. They own search, of course. Their cloud business is very, very profitable and growing very quickly. They've got other bets, which is comes out of their $20 billion yearly R&D budget. So they've got a great many very, very talented, smart people working to develop new products for Alphabet that they'll be able to monetize into the future. YouTube, which of course 5 years ago didn't produce much in the way of economic benefit for Alphabet, is now a major contributor for them. And this is a company that's growing at 20% annually, both revenues and earnings, and trades at about 20 times earnings. So it's a very inexpensive way to get into the communication services area.
What about Meta Platforms? Would you be a buyer of that one?
We sold our position in Meta in 2 tranches, one last summer at about $345 a share, which of course was prescient, but also we sold it when it started to falter earlier this year. We just couldn't see the business plan as clearly as we needed to, moving away from their traditional businesses into the metaverse, as Zuckerberg characterizes it. And it just wasn't clear enough to us that they were going to sustain the types of growth rates that we needed.
What about, I wanted to ask you this earlier, Gordon, Netflix. Would you be interested in Netflix? Because I know you do see promise in Disney.
We do. Netflix is a bit of a different animal. I think you have to be a little bit careful when you look at the earnings and cash flow of Netflix. The cash flow is challenged. The earnings tend to stand up better. And the reason for that is that they amortize a great many of their costs of producing original productions over many years. So they don't hit the earnings line, boosting the earnings in the early days, but it does hit cash because you have to pay for it. So in looking at Netflix, watch the cash, not the earnings, and be a little bit careful. I'd rather go with a Disney that has more diversification.